How does a hospital chain multiply its revenues more than 12 times in just a decade and still struggle to convert it into free cash flow? Welcome to the story of Yatharth Hospital, a rising star in Indian healthcare, growing fast but with complex financial undercurrents. Today, we'll unpack this contradiction and discover whether this is a value pick or a value trap. Yatharth Hospital and Trauma Care Services. Lutid is a rapidly growing hospital chain based in India's national capital region. What began as a modest 250-bed facility in Noida has today become a 405-bed multi-specialty healthcare powerhouse across 4 hospitals. From emergency trauma to neurology, cardiology, and oncology, Yatharth operates high-end tertiary care hospitals that serve both urban and semi-urban markets. During FY17 to FY25, the company has scaled its revenue from Rs 71 crore in FY17 to over Rs 880 crore in FY25, a remarkable compound annual growth rate of over 33%. But beyond these impressive top-line numbers lies a more nuanced financial story, involving intense capital investment, fluctuating margins, and the challenge of converting accounting profits into actual cash. Yatharth's strategy is built around the cluster model, expanding in tightly focused regional zones to improve branding, operational efficiency, and patient loyalty. With an IPO in 2023 and expansion into Jhansi, Yatharth is now venturing beyond the NCR region while still keeping control over operations. However, with high Capex needs, NCR concentration risk, and pressures on working capital, the real question is, can this hospital chain deliver not just medical care, but sustainable shareholder returns? In this video, we'll break down every layer, from revenue, margins, cash flow, ROCE, promoter behavior, and future scenarios, all using the deep, fundamental lens of respected Dr. Vijay Malik's value investing principles. So whether you're a new investor or a seasoned one, by the end of this, you'll know exactly how to think about Yatharth as a stock. To understand Yatharth Hospital as an investment, we must begin with its core business model, a focused, regionally driven hospital operator offering affordable yet advanced tertiary care. Yatharth currently operates 5 major hospitals across the National Capital Region, NCR, Greater Noida, Noida Sector 110, Noida Extension, acquired Ramakrishna Hospital in 2019, Greater Faridabad, operationalized in FY24, and Dwarka, Delhi, commissioned in Q4 FY25. Together, these centers have built a bed capacity of over 1,800, with around 1,400 beds operational as of FY25. The company's entire strategy revolves around these physical assets, structured under a cluster-based expansion model. What is the cluster model? Instead of spreading thin across India, Yatharth goes deep, saturating specific zones like NCR. This boosts operational efficiency, staff mobility, brand recall, and vendor contracts, all while keeping admin and marketing costs in check. Think of this like owning all the best restaurants in one neighborhood before opening in another city. It makes the entire operation leaner and smarter. Revenue comes mainly from inpatient department (IPD), ICU care, surgeries, diagnostics, imaging, core revenue driver, outpatient department (OPD), consultations, minor diagnostics, in-house pharmacy sales, higher margins from internal drug supply, and diagnostics and pathology, fully in-house, maintaining quality control. Notably, Yatharth does not outsource pathology, keeping clinical consistency and boosting margin. In FY25, Yatharth's RPOB, average revenue per occupied bed, was Rs 30,829, and occupancy stood at 61%, with higher occupancy in mature centers like Noida and Greater Noida, while newer units like Faridabad and Dwarka are still ramping up. Yatharth's growth has followed 2 paths: brownfield acquisition, buying running hospitals like the Noida Extension Unit in 2019, and greenfield projects, starting new hospitals from scratch. Faridabad and Dwarka are examples. In July 2023, the company raised Rs 687 crore via an IPO. This capital was earmarked for setting up the Faridabad Hospital, prepaying some outstanding loans, and upgrading medical infrastructure and digital systems. As per management disclosures, IPO fund deployment has closely followed declared intent, indicating governance credibility. Yatharth isn't chasing ultra-premium brand value like Apollo or Medanta. Instead, it positions itself as a value-for-money tertiary care provider in the NCR. Its model is, run by doctors not private equity, offer Tier 1 quality care at Tier 2 prices, target insurance-paying and TPA-referred patients from Delhi, UP and Bihar. This helps it attract a wider middle-class base without diluting margins. Yatharth doesn't yet have a deep competitive moat like Medanta's doctor network or Narayana's scale pricing, but it does have a partial moat from doctor-led ownership, ensuring alignment with clinical outcomes and shareholder value. Cluster-driven cost efficiency, fewer marketing, HR and admin redundancies, and increasing RPOB and stable occupancy, showing pricing power and demand stickiness. However, concentration in NCR remains both a strength and a risk. A single region disruption could hit multiple units. In summary, doctor-run, cluster-scaled, capital-efficient hospital chain targeting middle-income India with high-quality tertiary care, funded by IPO, now at a critical scale-up phase. If you're investing in any capital-heavy company like a hospital chain, the first thing you should study is its financial trajectory, especially how consistently it has scaled without breaking its balance sheet or burning through cash endlessly. Let's decode Yatharth Hospital's financial journey from FY 2016 to FY 2025, a decade that saw it grow from a niche trauma care unit to a regional healthcare chain with Rs 880 crore in annual revenue. In FY 2017, Yatharth's revenue stood at just Rs 71 crore. Fast forward to FY 2025, it clocked Rs 880 crore. That's a compounded annual growth rate, CAGR, of approximately 32% over 9 years, which is exceptional for a hospital company. What drove this? New hospital launches in Faridabad and Dwarka, RPOB growth from Rs 27, 800 month to over Rs 30, 800 month in FY 25. High-end specialties like oncology, neuro and cardiac boosting margins, and geographic saturation in NCR under the cluster model. This isn't just top-line growth, it's high-quality growth, backed by capacity addition, case complexity, and pricing power. Let's now talk about profitability, a metric many overlook when they see big revenue jumps. In FY 17, Yatharth had an operating profit of Rs 17.6 crore and an OPM of 24.8%. Fast forward to FY 25, operating profit hit Rs 220 crore, though margins compressed slightly to 25%, down from 31.6% in FY 21. Why the compression? New hospitals like Faridabad and Dwarka ran at low utilization in their early months. These hospitals incur full operating costs before they reach revenue efficiency. When adjusted for these new units, the mature hospital OPM is closer to 27%, suggesting the business is still fundamentally profitable. On the net profit side, Yatharth has come a long way. From just Rs 3 crore in FY 17, the company reported Rs 131 crore in PAT by FY 25. This growth reflects not just scale, but also better payer mix, control over finance costs, and improved margin structure. But it's not been a straight line. FY 20 showed a small loss due to high depreciation and interest burden, common during expansion cycles. Still, since FY 21, PAT has compounded steadily. Note, PAT margins are still modest, 17.1% in FY 25, because of high depreciation, a side effect of being an asset-heavy business. Now let's talk returns, the lifeblood of shareholder value. Return on capital employed, ROCE, hit a peak of 24.2% in FY 23. That's elite territory for hospitals. But in FY 25, ROCE dropped to 13.0%, and ROE, return on equity, fell to 10.5%. Why the drop? Capex for Faridabad and Dwarka inflated the capital base, but revenue from these hospitals is still ramping. IPO in FY 24 diluted equity, which temporarily suppresses ROE until earnings catch up. Important insight. Even in FY 25, ROCE remained positive, showing that core operations are sound, despite short-term return compression from scaling. This is a U-shaped return curve. Down in the early years, peak in FY23 and a predictable dip again due to fresh investments in FY24-25. Most investors look at revenue and profit, but seasoned investors, they watch cash flow. Because what really matters is the business turning paper profits into actual cash? In hospitals, a capital-intensive, slow-churn industry, free cash flow is often negative during expansion. But how Yatharth has navigated this challenge reveals the maturity of its financial engine. Cash flow from operations, or CFO, is like the business's salary. It tells us how much cash is generated from patient billing, pharmacy sales, and services, after paying all regular operating costs. In Yatharth's case, CFO in FY17, Rs 25 crore, CFO in FY21, Rs 44 crore after maturity of older hospitals. CFO in FY23, Rs 64 crore, FY24, negative Rs 3 crore, major red flag, FY25, rebounded to Rs 150 crore, the highest ever. So what happened in FY24? Heavy receivables build-up due to new hospitals billing large insurance claims. Initial ramp-up losses at Faridabad commissioned FY24. Insight. FY25 recovery shows these were temporary working capital issues, not systemic breakdowns. Capital expenditure, or Capex, is the cost of expansion, new beds, equipment, buildings. From FY17 to FY25, here's the pattern. FY17-20, Rs 40, 120 crore per year for older units. FY21-23, Capex eased to Rs 2080 crore per year as existing units matured. FY24, Rs 173 crore Capex for Greater Faridabad. FY25, a whopping Rs 442 crore Capex, largely for Dwarka unit. That explains the squeeze on free cash. Free cash flow equals CFO minus Capex. Here's the story over time. FY17 saw CFO of Rs 24, 95 crore, Capex of Rs 124, 64 crore, resulting in FCF of negative Rs 99, 69 crore. FY21 showed CFO of Rs 43, 67 crore, Capex of Rs 20, 28 crore, resulting in positive FCF of Rs 23, 39 crore. FY23 had CFO of Rs 63, 78 crore, Capex of Rs 22, 93 crore, resulting in positive FCF of Rs 40, 85 crore. FY24 showed CFO of negative Rs 3, 08 crore, Capex of Rs 172, 66 crore, resulting in FCF of negative Rs 175, 74 crore. FY25 had CFO of Rs 149, 60 crore, Capex of Rs 442, 42 crore, resulting in FCF of negative Rs 292, 82 crore. Insight. Yatharth has oscillated between positive and negative FCF depending on the phase of its expansion cycle. FY21 and FY23 were positive FCF years, with Capex under control. FY24-25 saw FCF collapse again due to dual hospital commissioning. But importantly, CFO surged in FY25, meaning the core business is maturing. This is not a cash-burning model. It's a temporarily cash-absorbing one due to Capex front-loading. Key red flags to watch. FY24's negative CFO should not repeat. Investors must monitor if receivables or working capital swell again. Capex of Rs 442 crore in FY25 is among the highest ever. Positives that signal strength. CFO growing from Rs 64 crore to Rs 150 crore shows strong operating leverage. No aggressive debt or dilution despite Capex. IPO funds were used wisely. Once Faridabad and Dwarka reach stable occupancy, FCF could flip positive again, likely around FY26-27. Summary. Yatharth's FCF is negative now, but for the right reasons. CFO trends show core operations are healthy. In long-term investing, there's one key question that separates scalable businesses from capital traps. Can a company grow without constantly raising external money? This is where the concept of self-sustainable growth rate, or SSGR, comes in. And for capital-intensive sectors like hospitals, SSGR can tell you more than PAT or ROCE ever will. SSGR tells us the maximum growth rate a company can achieve purely using its internal cash flows, without needing debt or dilution. It's derived from reinvestment rate and return on capital employed. Formula-wise, SSGR equals ROCE times reinvestment rate. So if a company earns 20% ROCE and reinvests 50% of its profits, it can grow at 10% sustainably. Let's break this down across years. In FY17, ROCE was 10.8%, reinvestment rate was 126.8%, resulting in SSGR of negative 13.6%. Debt-driven, unsustainable. FY18 showed ROCE of 7.6%, reinvestment rate of 184.6%, SSGR of negative 13.9%. FY20 had ROCE of 13.4%, reinvestment rate of 51.6%, SSGR of 6.9%. Some internal growth begins. FY22 showed ROCE of 15.6%, reinvestment rate of 50.3%, SSGR of 7.8%. Improving capital efficiency. FY23 had ROCE of 24.2%, reinvestment rate of 50.4%, SSGR of 12.2%. Peak performance, good SSGR. FY25 showed ROCE of 13.0%, reinvestment rate of 130.7%, SSGR of 17.0%. High reinvestment, Capex loaded. What does this tell us? In early years, SSGR was negative. Growth was funded by debt. By FY22-23, ROCE improved, making the model self-sustaining at 7.12%. In FY25, reinvestment surged due to IPO and Capex, so SSGR jumped to 17%. That means if Yatharth simply reinvests current profits at current efficiency, it can grow at 17% per year without needing debt or new equity. This is exceptional for a hospital chain. Why SSGR matters to investors. High SSGR equals internally funded growth, which means lower debt risk. It allows hospital chains to scale without pledging, dilution, or high-interest loans. SSGR also aligns with free cash flow generation in the long term. A 17% SSGR places Yatharth in the top tier of Indian hospital chains. Even Apollo and KMS operate in the 12-18% zone depending on the year. More importantly, Yatharth has now reached a mature cash-generating zone. Investor takeaway SSGR tells us how fast a company can grow organically. Yatharth's jump to 17% SSGR in FY25 signals strong fundamentals. If sustained, it means fewer external fund needs and more value for shareholders. Operational efficiency is where hospital chains make or lose real money. For Yatharth Hospital, an asset-heavy, high-service intensity model, this means efficiently managing beds, billing, inventories, receivables, and vendor payments. Let's decode the engine room of this business and see how well Yatharth keeps cash circulating. Hospital profitability begins at the bed level because fixed costs like electricity, staff, and medical infrastructure run regardless of how many patients show up. Yatharth's overall occupancy rate as of FY25 stood at 61%, with a clear split between mature hospitals, Noida, Greater Noida, over 70% occupancy, new hospitals, Faridabad, Dwarka, around 40-45% occupancy as of Q4 FY25. This explains why margins have compressed. Hospitals like Dwarka are operational but still in early revenue ramp-up. Key insight. Fixed cost pressure hits new hospitals hardest. Until they cross 60% occupancy, they run sub-optimally. Next comes the bloodline of hospital cash, working capital. This includes inventory, like drugs and medical supplies, and receivables, payments pending from insurers, TPAs, and patients. Let's focus on two metrics. Receivables days tell us how long Yatharth takes to collect cash after billing. If a surgery is billed today, when does that money actually land in the bank? Over the years. FY19, 42 days. FY21, 46 days. FY23, 74 days. FY25, 110 days. This is a concern. Receivables are rising, especially with higher dependence on insurance billing. A 72-day DSO also means 2 full months of revenue is stuck in pending collections. Why? New units deal more with insurance TPA clients, which have longer payout cycles. Yatharth maintains a decent grip on inventory turnover, which includes medical consumables, implants, and critical drugs. Inventory days have remained within the range of 5 to 10 days over the years, which is acceptable for tertiary care. There's no major red flag here, but when new hospitals open, initial inventory buildup is natural. On the flip side, how long does Yatharth take to pay its vendors? Payable days hover around 50, giving them breathing room. This means the hospital pays vendors after approximately 50 days, but often receives payments from patients, especially cash-paying or insured ones, much sooner. As a result, the hospital typically receives money faster than it has to pay it, which actually reduces working capital pressure and improves cash flow. Net working capital equals receivables plus inventory minus payables. In FY 21-22, net working capital cycle was around 25-30 days, manageable. In FY 24-25, NWC cycle exceeded 50 days, meaning more cash tied in operations. And when Capex is also running high, this can crush free cash flow, exactly what happened in FY 24. Red flags include receivables spike to 110 days needs urgent management focus. New hospitals must ramp up quickly to reduce cash strain. Delayed collections from TPAs can create seasonal cash flow mismatches. Positives include inventory discipline is maintained, no major wastage. Payables management is efficient, giving time cushion. Cash from operating activity, CFO, in FY25 is 150 crore. CFO recovery in FY25 shows collections improving. No matter how good a company's numbers look, if the promoters are questionable, the stock is uninvestable. In this scene, we'll explore who's behind Yatharth Hospital, how they behave with money, and whether their governance inspires investor confidence. Yatharth Hospital is run by its founding team of doctors, most prominently Dr. Kapil Tyagi, who serves as the managing director. He is an MS orthopedic specialist and leads clinical strategy. Along with his family, he owns a significant stake in the company. The other promoters include medical professionals from similar backgrounds. This is important because unlike private equity-run hospitals that often chase financial engineering, Yatharth is doctor-led. That brings both alignment with patient outcomes and a long-term vision. As of FY25, promoter and promoter group holds 66.4% of the company. This is a healthy level, above the 50% safety threshold. It shows that promoters still have strong skin in the game. More importantly, there is zero promoter pledging. No shares have been pledged to lenders. This is a crucial green flag in India's mid-cap space. Promoter salary is often a red flag area in small caps, where owners treat the company like their ATM. Not here. Dr. Kapil Tyagi drew a total compensation of Rs 120 CR in FY25, just 0.13% of total revenue. All executive compensation is well below SEBI's red flag limits. No excessive bonuses or variable payouts during IPO year. This shows restraint and signals governance maturity. Yatharth's auditor is Walker Chandiok and Company LLP, a reputed Indian audit firm and member of Grant Thornton's network, well known for its mid-cap healthcare audits. So far there have been no qualifications or remarks in auditor reports, no related party red flags in RPT disclosures, no whistleblower cases or insider trading inquiries. Subsidiaries are minimal and fully disclosed. Yatharth operates a clean, non-layered structure without complex holding companies. Yatharth raised Rs 687 crore in July 2023. Did they misuse it? Not at all. Funds were used exactly as committed, to reduce debt, expand Faridabad, and improve equipment. No sudden land deals, luxury office purchases, or suspicious intercorporate loans. Investor takeaway. IPO governance matches the declared plan, a rare but crucial check. Capital allocation is where great companies separate themselves from good ones. How a business chooses to spend or not spend its profits determines not only its return ratios, but also its survival during stress. For Yatharth Hospital, capital allocation has undergone 3 clear phases: debt-funded early growth, IPO-fueled expansion, and now a disciplined, slightly deleveraged phase. Let's look at where Yatharth has deployed capital in the last 5-6 years. FY 17-20. Majority of cash went into brownfield Capex, like Noida extension, and some working capital buildup. FY 21-22. Operational stabilization. Capex slowed, more funds deployed toward debt servicing and improving balance sheet metrics. FY 23-25. Major IPO-fueled expansion, focused on building the Faridabad and Dwarka units from scratch. Through all of this, the company maintained a strong preference for owning assets rather than leasing. This increases upfront cost but offers control and higher lifetime margins. Yatharth raised ROCE 687 crore via IPO in July 2023. As per its filings and presentations, Capex for Greater Faridabad unit, RS 170, 5 crore, repayment of borrowings, RS 65 crore, general corporate purposes and infra, RS 50 crore, working capital buffer, balance, Rs 400 crore. As confirmed in FY 25 updates, these fund uses were exactly followed. No unrelated acquisitions, no sudden dividend announcements, no opaque treasury flows. This is a strong governance indicator. Let's talk about leverage and financial strength, a key lens through which we judge any capital-heavy business like hospitals. Yatharth Hospital's journey from high debt to a net cash position is nothing short of remarkable. In FY 22, the company was still in the thick of its Capex cycle. Gross debt stood at a substantial Rs 263. 78 crore cash and equivalents were modest, just Rs 12.08 crore net debt, Rs 251, 7 crore. This translated into a net debt to equity ratio of 2.26x, clearly in the red zone. Interest coverage ratio, 4.08x, decent but still reflective of a stretched balance sheet. At this point, Yatharth was relying heavily on borrowed capital to fund its growth, especially for expanding into new hospitals like Faridabad. Fast forward to FY 24, a strategic turning point. Gross debt reduced significantly to Rs 84. 65 crore cash and equivalents surged to Rs 238. 64 crore net debt turned negative. A net cash position of over Rs 154 crore net DE ratio dropped to 0.10x. Interest coverage ratio improved to 8.62x. Thanks to the IPO proceeds, Yatharth prepaid a large chunk of its debt and built up a strong liquidity buffer. The company wasn't just stable, it was now fortified. By FY 25, the transformation was complete. Gross debt had fallen to just Rs 11. 59 crore cash and equivalents ballooned to a massive Rs 515 crore net DE ratio was nearly zero. 0.007x. Interest coverage ratio skyrocketed to 38.13x, among the best in the industry. This is no longer a company at financial risk. Yatharth is now a capital-efficient healthcare platform with the firepower to fund future growth internally. Key takeaways: a hospital chain moving from high leverage to net cash in just 3 years, while growing revenue and profits, is a strong signal of execution discipline and capital prudence. For long-term investors, this level of financial control reduces downside risk and improves the company's ability to withstand regulatory, operational, or economic shocks. This is not just a balance sheet repair story. It's a signal that Yatharth is now entering its next growth cycle from a position of strength. Capital risk zones to monitor. If the company starts another large Capex cycle before Faridabad and Dwarka break even, debt could spike again. Returns on these new hospitals must justify upfront cost, else ROCE will remain subdued. Positives in allocation behavior: no unnecessary acquisitions or diversification. IPO funds used as declared, no dividends yet. Focus remains on reinvestment, not short-term signaling. Core focus is on expanding organically within familiar geographies. Summary: occupancy is climbing, but new units are dragging blended margins. Receivables are the biggest watchpoint, now at 110 days. Inventory and payables are under control. If occupancy rises and receivables stabilize, cash conversion will dramatically improve by FY 26. Overall, Yatharth checks out as a governance-positive stock, especially rare in mid-cap hospitals. Doctor-led, unpledged and auditor clean. This builds the foundation of investor trust. Yatharth's capital allocation is disciplined, growth-focused, and transparent. Its balance sheet is light, leverage is under control, and Capex is backing strategic hospital additions, not vanity projects. Even the best hospital chains face hidden landmines, and Yatharth is no exception. While its growth is impressive and governance is sound, investors must pay close attention to certain strategic risks that could derail the story if not managed well. Yatharth's biggest strength, its cluster-based strategy, is also its greatest vulnerability. Over 90% of its revenue comes from just one region, the National Capital Region, NCR. This exposes it to policy risks like Delhi pollution shutdowns, price controls, or sudden regulation on private hospitals. Regional saturation. Beyond a point, growth must either slow or expand outside comfort zones. Epidemic risk or civic disruptions could impact all hospitals simultaneously. While the cluster model works brilliantly for efficiency, diversification is necessary for de-risking. As we covered earlier, Yatharth's receivables days have ballooned to 110 days in FY25, the highest ever. This creates two concerns. Delayed cash collection affects liquidity and strains working capital. If TPAs or government schemes delay payments, cash flow volatility spikes. Receivables must be monitored like a hawk, because cash profit is real profit. If DSO rises further, even strong EBITDA may not save free cash flow. New hospitals take 18-24 months to break even. As of FY25, Faridabad and Dwarka are still early stage, with occupancy in the 40-45% range. Risk. These hospitals have soaked up Rs 600 plus crore in Capex. If occupancy doesn't ramp up quickly, ROCE and margins will stay suppressed for longer than planned. Yatharth could be tempted to delay further Capex, hurting long-term scale-up. Investor takeaway: track quarterly occupancy data closely. Yatharth's ROCE has fallen from 24.2% in FY23 to just 13% in FY25. This is normal post-expansion, but sustained low ROCE may question the efficiency of Capex. The company must prove that Faridabad and Dwarka can deliver ~20% ROCE in 2-3 years. If they remain subscale, capital productivity will remain weak despite revenue growth. In FY25, Yatharth's free cash flow was negative Rs 293 crore. This is due to massive Capex, not because of loss-making, but still means the company needs strong internal accruals to fund working capital. Any delay in patient ramp-up or cost control can push the firm toward external debt or equity again. If the company starts another greenfield hospital before cash flows recover, leverage could rise again. This is not a broken model, but a capital-strained scale-up story. Investors must stay alert, not alarmed. No aggressive debt buildup. Leverage is still low. IPO funds were used wisely, not misallocated. Core hospital RPOB and mature occupancy still strong. Risk dashboard. NCR revenue concentration. 90% plus revenue from one region, high receivables pressure. 110 days DSO in FY25 medium-high. Ramp-up risk, new units. Less than 50% occupancy in new hospitals, medium, ROCE compression. 24% to 13% in 2 years, medium. Free cash flow deficit, minus 293 crore FCF in FY25 medium. These are the key risks investors must track closely. 1. Sales growth greater than 15% CAGR. Yes. Revenue grew from 71 crore in FY17 to 880 crore in FY25. A 32% CAGR. Exceptional. Pass. 1. ROCE consistently above 15%? Mixed. ROCE peaked at 24.2% in FY23, but fell to 13% in FY25 due to Capex. Watchlist. Expect return normalization by FY27. 1. Free cash flow track record, intermittent. FCF was positive in FY21 and FY23, but turned negative in FY24 and 25 due to expansion. Needs monitoring. 1. SSGR positive and sustainable? Yes. FY25 SSGR stands at 17%, up from negative in early years. Pass. 1. No equity dilution outside IPO? Correct. No preferential issues or frequent QIPs post-listing? Pass. 1. Promoter holding above 50%, no pledging? Yes. Promoters own 66.4% and have pledged 0 shares. Strong pass. 1. Promoter salary reasonable? Yes. 1.2 crore or about 0.13% of revenue, well below SEBI thresholds. Pass. 1. No auditor or governance red flags? Yes. Auditor, Walker Chandiok LP, no qualified reports. Pass. 1. No aggressive Capex beyond CFO capacity, partially. FY25 Capex, 442 crore, is greater than CFO, 150 crore, resulting in negative free cash flow. Monitor for FY26 and 27 recovery. 1. Debt less than equity, healthy coverage? Yes. FY25, net debt to equity is 0.007 times. Interest coverage is 38.1 times. Pass. 1. Working capital cycle stable? No. Receivables rose to 110 days. Working capital needs attention. Fail. Current red flag. 1. Margin profile consistent? Yes. Core operating margin has stayed around 25 to 27% even during Capex years. Pass. 1. Asset turns and utilization improving? Yes, in mature hospitals, no in new ones which are early stage. Split score. 1. No complex structures or related party transaction abuse? Yes. No subsidiaries misuse? Related party transactions are clean? Pass. 1. Clear, honest IPO use? Yes. Fund use exactly matched prospectus declaration? Pass. That's a solid score for a capital-intensive hospital chain. Pass. 11 out of 15. Watchlist 3. Fail. 1. The only real red flag is working capital stress. Everything else is either a temporary dip from Capex or a long-term strength. For long-term investors, this checklist shows that Yatharth is fundamentally sound, founder-aligned, and at the right side of a scale-up story. Now that we've dissected Yatharth's business model, finances, risks, and governance, it's time to project the future. What happens from here? Can this Rs 880 CR hospital chain become the next mid-cap compounding story? Or will it scale up, strain cash and returns? In the optimistic scenario, both Faridabad and Dwarka ramp to 70% plus occupancy by FY27. Receivables reduce to 50-55 days and Capex moderates. In this case, revenue crosses Rs 300 CR by FY27. Core margins return to 27-28%. ROCE climbs back above 18%. Free cash flow turns positive from FY26 onward. Valuation could re-rate from current -39x to 42-45x earnings if ROE rebounds. Target outcome: long-term compounder with hospital-led pricing power, high RPOB and NCR dominance. Here, occupancy grows slowly to 60-65% by FY27, with working capital improving only marginally. The company avoids fresh Capex until FY28. Revenue grows to Rs 101,200 CR range. Margins stabilize at -26%. ROCE stays in 13-16% band. Free cash flow becomes neutral to positive by FY27. Stock remains stable, delivering 12-15% CAGR returns, but doesn't see major re-rating. Target outcome: a steady, well-governed, regional healthcare player with moderate return profile. In the downside scenario, Dwarka or Faridabad fail to hit break-even. Receivables worsen, and the company is forced to raise debt or dilute equity by FY26. Revenue remains less than 1,000 crore till FY27. Free cash flow stays negative. ROCE dips below 10%, leverage rises again. Valuation derates below 20 times price to earnings. Stock underperforms due to poor capital productivity. Target outcome: cash-strapped hospital chain with muted growth, balance sheet pressure. Yatharth Hospital is a capital-heavy but margin-rich business with doctor-led governance and an ambitious growth trajectory. Its FY25 numbers reflect a business at an inflection point, compressing on cash, expanding in infrastructure. But its strengths stand tall. Cluster focus ensures deep regional brand strength. Core hospital profitability remains solid. SSGR of 17% gives confidence in self-funded growth. Governance is cleaner than most mid-caps. The key to its future? Faridabad and Dwarka must deliver. If they do, Yatharth could emerge as a leading NCR-based specialty care compounding story over the next 5 years. If they don't, investor returns may flatten or shrink. Disclaimer: The content in this video is for informational and educational purposes only. It does not constitute financial advice or a recommendation to buy, sell, or hold any security. Please consult a registered investment advisor before making any investment decisions. All data used is sourced from publicly available company filings, investor presentations, and reports as of FY25. Future scenarios are illustrative and subject to change based on actual performance and market conditions. If you found this deep dive analysis valuable, don't forget to hit the like button and subscribe for more investor-grade breakdowns like this. Have a company you'd like decoded next? Drop it in the comments. Thanks for watching, and stay invested.